Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. Fed minutes signal policy patience as officials divided on rate path. 2. Iran-US nuclear talks whipsaw oil markets as military risk resurfaces. 3. RBNZ dovish hold signals extended accommodation for NZ recovery. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. Fed minutes signal policy patience as officials divided on rate path. Primary asset classes impacted. U.S. equities, S&P 500, NASDAQ Tech, UST 2-year to 30-year curve, DXY and dollar crosses, risk-sensitive FX pairs. What happened? January FOMC minutes showed several officials open to rate hikes if inflation stays elevated, with committee deeply divided on timing of next cut. 2 governors dissented for further easing at that meeting. Majority emphasized no rush to ease policy given strong economy and labor market stabilization. Why it matters. Hawkish tilt from Fed officials who previously ruled out hikes signals risk tolerance for higher for longer rates has increased. This reprices terminal rate expectations upward, steepening short-end Treasury curve and supporting dollar strength. Division within committee amplifies policy uncertainty, increasing volatility in rate-sensitive assets and reducing visibility on easing timeline for credit markets. Key numbers to remember. OCR held at 3.50 to 3.75% after 3 cuts in late 2025. CPI inflation at 2.4% in January, above 2% target for nearly 5 years. Several officials want to see further inflation decline before supporting additional cuts. What to watch next? Friday PCE inflation data becomes critical test for dovish camp advocating continued easing versus hawks favoring extended pause. Sustained core PCE above 3% or labor market strength would embolden hawks, pushing markets to price longer pause and potential hike scenarios. Conversely, softer inflation readings coupled with labor market cooling would support March cut repricing and compress UST front-end yields. 2. Iran-US nuclear talks whipsaw oil markets as military risk resurfaces. Primary asset classes impacted. Brent and WTI crude, energy equities, Middle East sovereign spreads, gold and safe havens. What happened? Oil prices reversed Tuesday gains after Vice President Vance stated Iran ignored key U.S. demands in Geneva talks, with President Trump indicating military strikes remain on table. Iran characterized discussions as constructive, but Vance contradicted, citing inadequate response on fundamental U.S. expectations. Prices jumped over 4% Wednesday on escalation risk. Why it matters. Strait of Hormuz handles 1/3 of global maritime crude exports, making military escalation a Tier 1 supply disruption risk. Iran Revolutionary Guard conducting drills in strait amplifies signaling risk. Axios reports any U.S. military operation would be weeks-long campaign resembling full-scale war, not targeted raid, elevating risk premium across energy complex and Middle East credit. Key numbers to remember. WTI closed $65.19, up 4.59%, Wednesday after $62.33 Tuesday close. Brent closed $70.35, up 4.58%, Wednesday after $67.42 Tuesday close. 1/3 of global maritime crude transits Strait of Hormuz. What to watch next? Geneva talks resumption or breakdown will drive near-term oil volatility. Failure to reach guiding principles agreement by late February would elevate strike probability, pushing Brent toward $75 to $80 as markets price supply disruption scenarios. Conversely, credible progress toward nuclear framework could collapse risk premium, sending crude below $65. Watch USS carrier deployments and Iranian military posturing for escalation signals. 3. RBNZ dovish hold signals extended accommodation for NZ recovery. Primary asset classes impacted: NZD/USD, New Zealand government bonds, AUD/NZD cross, Australian equities and NZ equities. What happened? Reserve Bank of New Zealand held OCR at 2.25%, lowest since mid-2022, while signaling policy remains accommodative for some time. RBNZ brought forward rate hike expectations to late 2026 or early 2027 from mid-2027 previously. Governor Bremen emphasized laser focus on returning inflation to 2% midpoint over next 12 months. Why it matters. Dovish hold reduces near-term tightening risk that markets priced after inflation printed 3.1% in Q4 above target band. Extended accommodation supports household spending and business investment recovery despite soft labor market with unemployment at elevated levels. RBNZ confidence in disinflation path reflects spare capacity absorption, reducing urgency for tightening that would threaten fragile recovery momentum. Key numbers to remember. OCR held at 2.25%, lowest level since mid-2022. Inflation at 3.1% in Q4, above 1 to 3% target band. Next rate hike expected late 2026 or early 2027, brought forward from mid-2027. What to watch next? NZD faces dual pressure from extended low rates and narrowing rate differential versus Fed. Upcoming inflation prints in Q1 become critical test of RBNZ disinflation confidence. Faster than expected inflation decline could keep OCR on hold through year-end, supporting NZD carry trades, while sticky inflation above 3% would force earlier tightening and NZD appreciation. Watch household spending data for recovery confirmation. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.